So let's talk a little bit about how we can fuel our growth because the legs on this podcast is increasing revenue and driving growth with the ultimate goal of being able to sell your company. Not everybody's thinking of selling, but those two factors boost the last one. But when we're thinking about growth, how can a proactive tax advisor help us with growth in our company?
Well, I think certainly to the extent that you happen to operate in a business or a region where there are credits and incentives that can be really valuable. So I think, one that a lot of businesses in the technology space, don't think about for a while is sort of the R&D tax credits where actually you can get a meaningful tax break on your payroll taxes if you're thoughtfully doing the analysis on, hey, I'm actually employing people that's creating some new technology, software, et cetera, as it's defined. So historically, that was just a credit that you could use against profits. If you're a business that maybe, break even, that can be something that in, that immediate period actually can offset payrolls. That's really valuable. And there also are parts of the country where there are state level programs like in upstate New York, we're based uh, in New York. You can get credits for hiring people and stuff like that, is advantageous. I also think that strategic accountants, when you ask the right questions, can be helpful on understanding your working capital cycles, almost like a business advisor to some degree. Not that they're going to advise you on like raise your price or do anything. It's more of a business decision for you. But there may be things around the terms that you're accepting payments, or if they're really in your books and can kind of see, hey, your P&L looks great, but like these balance sheet metrics kind of stink. That's not the case for all, tax advisors, but there are three different financial statements for a reason, and that they all are telling you something very different. And so just because your P&L looks great, that this year's revenue is more than last year's, that two businesses that have exact same P&Ls may have highly different cash needs. And so when it comes to growth, the best kind of growth is growth that you're not financing out of your pocket, you're financing with your customers' dollars or with, other resources. And so I think ensuring that the combination of any internal finance resources you have with a more strategic CPA can help make sure that your, cash flow matches up with what you hope, balance sheet can look like. And your obviously your P&L and kind of the general performance.
I love that because that's something that again a lot of business owners rely heavily on their financial team to produce the documents, right? To be able to analyze and reflect on the data that comes out of those documents to help the company and the business owner make the best decision for moving the company forward. And I think having that advisor who can say, yeah, sure, your P&L looks great, but your balance statement is a mess. And have you thought of possibly doing this? And instead of taking your cash flow to buy the new equipment, or we've got these opportunities that are available because more so than the business owner that these opportunities are available, and hey, let's align with a financial tool that I think if you offset this or that. But the business owner, again, is relying on those professionals to come in and help them analyze the data of what the company's actually doing. So I
Totally.
love that. That really brings a new look on your tax professionals to be able to come in and give those advice. So, when we're looking at different angles for growth in companies, where are some of the missed opportunities that today's business owners aren't grabbing? Like you mentioned, those tax incentives to hire and create new technology. But when we're looking at maybe the balance sheet, as you said that there were some challenges there or missed opportunities, maybe where should they look?
Yeah, well, I think, it varies so considerably based on the industry, but I would say kind of like what I just alluded to, um, the cash flow cycles can be so different predicated upon how you think about, charging your clients and paying your own expenses. So I think that's one of the biggest ones in helping to bridge that gap. I think, like we had talked about a little bit earlier, um, understanding when you actually, whether you're a sole proprietor or you're, a multi-million dollar revenue generating small business, um, understanding when there's a cost to paying certain things, namely your taxes, or when you can defer some of those cash outlays. And again, have the growth, be bringing in new business, but not necessarily, again, having to raise capital or pay out of pocket to be able to hire more people to take on that demand or to finance your cost of goods sold or something like that, is the biggest piece. And I think, now they're also, which is not what the CPA drives, but more nuanced ways to think about lending as well. Like we see a lot of business owners where it's like, oh yeah, I just got it on a credit card, paid whatever, racking up 30% interest when there are lots of different vehicles that hey, all you need is a AR revolver, or all that's really needed is something for inventory management that's less than half the price. That stuff matters. And just strategic CPAs can sort of help identify, interest expense, other things that are driving, again, a suboptimal path for growth